Welcome to the deep dive. Today, we're really zeroing in on BigBear.ai, that's ticker BBAI.
Yep.
Lots of chatter, lots of movement recently, especially after their Q2 2025 earnings call. So we're going to unpack that for you.
It definitely caused a stir.
For sure. Now, for anyone maybe less familiar, BigBear.ai operates in, AI-powered decision intelligence, think critical sectors, national security, defense, even travel and trade.
Really important areas.
Absolutely. So our mission today is to break down those Q2 results, figure out why the stock took such a hit, and then, maybe most importantly, really dig into what CEO Kevin McAleenan is planning. He's got this bold new strategy.
Yeah, the going on offense part. Very
Sure.
interesting framing.
Exactly. Look, BBAI is in a tricky spot. Huge potential with AI trends, government spending, but also facing real challenges right now.
It's a complex pitch.
It is. So this deep dive, it's for you to help you quickly grasp all these moving parts, get, properly informed on BBAI.
Let's get into it.
Okay, so let's unpack this. The latest earnings call, quarter ending June 30, 2025. Some numbers definitely caught attention.
Understatement, yeah.
Revenue, for starters, down 18% year over year. Came in at $32.5 million.
Which was down from almost $40 million, $39.8 million in Q2 last year.
Right. And that significantly missed what analysts were predicting. They were looking for over $40 million.
That's a pretty big miss on the top line. And the why is crucial here, isn't it?
It is. They pointed primarily to lower volume on certain Army programs.
The Army consolidation effort. They're doing these efficiency efforts, modernizing their data architecture.
Exactly. So that seems to be the main driver for the revenue dip. How significant are shifts like that for a company like Big Bear, so tied into government work?
Oh, it's central. When a major client like the Army pauses or shifts direction, even temporarily for modernization, it hits the top line directly. It's not just a small ripple.
That makes sense. And it wasn't just revenue. Gross margin also slipped, down to 25% from almost 28% last year.
Indicating, more cost pressure, things are getting tighter there.
And then the number that probably made everyone sit up, the net loss.
Yeah, that was a headline grab.
A loss of $228.6 million. Compare that to $14.4 million loss in the same quarter last year. I mean,
Wow.
That's huge.
It looked incredibly dramatic. This is where you really need to look under the hood, right?
Absolutely, because that massive number, overwhelmingly driven by non-cash items.
Right. Explain those for us.
Okay, so there was a $135.8 million change related to derivative liabilities and a $70.6 million non-cash goodwill impairment charge.
Okay, so breaking that down simply for you listening. Derivative liabilities, that's often complex financial instruments changing value on paper. Goodwill impairment means they're saying an asset bought previously isn't worth as much now.
A key point.
No actual cash went out the door for these specific big charges.
Right.
It's accounting. It doesn't reflect their immediate operational cash situation.
Which is a critical distinction. It suggests their day-to-day cash health might be, way better than that bottom line loss implies. Gives them breathing room.
Exactly. A very important nuance often missed in the initial reaction. So, operationally, how did things look beyond that headline loss?
Well, non-GAAP adjusted EBITDA, that was negative $8.5 million, worse than the negative $3.7 million last year.
Okay, so still showing some operational strain.
Yeah, influenced by that lower gross margin we mentioned. And also, R&D expenses were up 23% year over year, about $4.4 million.
Investing in the future, presumably.
Presumably. On the plus side, SG&A selling general admin costs were actually down slightly, $21.5 million versus $23.4 million. Lower legal, lower bonuses helped there.
Okay. And the backlog. Always a key metric for companies like this.
Right. It stood at $380 million as of June 30th, which sounds big, but again, fell a bit short of what the market was hoping for, closer to $400 million.
So, summing up the financials. Revenue miss due to Army shifts, margin pressure, huge headline loss driven by non-cash items, wider adjusted EBITDA loss, and a slightly disappointing backlog. Clear headwinds.
Yep. And given all that, the market reaction, well, it was fast and it was pretty dramatic.
Not surprising, really.
The stock just plummeted on August 11th after the earnings miss. After-hours trading saw it drop over 20%. One report said 23%. Another even mentioned 28% down in after-hours.
Wow. Just highlights how sensitive the market is right now.
Yeah.
Any miss, especially with that kind of history.
Exactly, because this wasn't the first time. Q1 results also missed expectations pretty badly.
So there's a pattern emerging.
that investors are likely reacting to. For sure. And it just adds to the stock's overall volatility. I mean, look at the 52-week range. $1.20 on the low end, up to $10.36 on the high. Wild swings.
And where is it now, roughly?
Around $7.14 at the close we looked at, but then dropped more after hours, significantly below that 52-week high, and way below its all-time high of over $16 back in April 2022. Plus recent dips, down 4.5% in the last session, over 13% down the prior week.
Oof, that history definitely weighs on investor minds. What are the analysts saying amidst all this?
It's confusingly mixed, actually. One source averages analyst ratings to a buy, but their median price target is like 68% below the recent price.
Wait, a buy rating, but a target way lower than the current price. That doesn't add up.
It's weird, right? Then another source, initially positive, now says analysts have assigned a general sell rating. They're worried the price-to-sales ratio is too high, given, quote, stagnant growth and persistent negative cash flow.
So conflicting signals from analysts. Not exactly helpful clarity for you trying to figure this out.
Not at all. And the technical charts aren't looking great either.
Oh, yeah. What are they showing?
There was a sell signal triggered from a pivot top back on July 17th. Stock hit a peak, then started trending down. It's lost over 13% since then.
Okay, that's a clear negative technical sign.
Plus, there's a sell signal from the 3-month May CD.
Ah, the moving average convergence divergence. So short-term momentum falling below long-term.
Yeah.
Another bearish signal.
Right. So even if there are some positive moving average signals mixed in, the overall technical picture seems tilted towards sell right now, which all leads to it being classified as, high risk, huge daily swings, high volatility.
Yeah, it really makes you wonder, doesn't it? You have this company, BigBear.ai, with a really critical mission in AI, national security. Clearly identified growth areas, yet the market reaction is so harsh, so immediate.
It's a disconnect.
It feels like investors are just laser focused on these near-term misses, the historical volatility, maybe overlooking the potential long-term story, or perhaps just being very cautious.
Which brings us perfectly to the next part, because this is where it gets really interesting. Despite all those challenging numbers and the market reaction, CEO Kevin McAleenan steps up and lays out this incredibly ambitious future vision, a major strategic pivot. He literally used the phrase, going on offense.
It's a strong statement after a tough quarter. What's backing that up?
Cash. Lots of it. The most significant highlight, maybe the biggest surprise from the whole presentation, their balance sheet.
Okay.
Record cash balance, nearly $391 million at the end of Q2.
Wow, $391 million cash after that huge net loss figure.
Exactly. It's the first time they've ever had a net positive cash position. About $248 million net cash when you account for their $143 million debt.
Okay, hold on. How did they pull that off? Where did almost $300 million in cash come from?
They raised it through at-the-market facilities. Basically, they sold about 75 million new shares directly into the market over time.
An ATM offering. Selling shares gradually to raise capital without crashing the price all at once. Smart.
Yeah, at an average price of about $3.90 per share. Raised roughly $293 million doing that.
So that explains the war chest.
And the CEO, McAleenan, directly said, quote, "Our record cash balance will enable us to make significant investments, both organically and inorganically, in an order of magnitude that was not possible before."
That's the key right there. That cash gives them massive optionality to actually execute this offense strategy.
And a big part of that strategy hinges on something he called the One Big Beautiful Bill, or OB3.
OB3, right. This recently passed legislation.
He believes it's going to bring generational investment, transformative funding, and it's, quote, directly in our lane.
Okay, so not just general government spending, but targeted funding.
Exactly. We're talking huge numbers. $170 billion supplemental for Homeland Security, $150 billion for the Defense Department, focused on disruptive tech.
That's serious money. Any specifics relevant to Big Bear?
Oh, yeah. He highlighted U.S. Customs and Border Protection, CBP. Over $70 billion earmarked for them over 4 years.
$70 billion for CBP.
Yep. Including $6.2 billion specifically for border tech, $673 million for biometric exit solutions. McAleenan said that's like 4 times the incremental funding CBP usually gets.
Okay, so massive potential funding boost in areas where Big Bear tech could fit perfectly.
And it's not just CBP. There's a $16 billion military AI fund for things like swarming unmanned aerial systems.
Which lines up with their Conductor OS for drones.
Precisely. And $29 billion for domestic shipbuilding.
Shipyard AI platform. Got it.
So the OP3 funding seems really tailored to their specific capabilities. It's not just a rising tide, it's targeted streams.
That context is critical. It makes the offense strategy seem much more plausible if the funding environment aligns so well. And they're looking beyond the U.S. too, right?
They are. They mentioned a transformative partnership signed with companies in the UAE under the IHC umbrella, focusing on AI development.
UAE. There was a huge investment number floated around that, wasn't there?
One source mentioned a potential 1.4 trillion joint AI investment initiative involving the UAE, though details are sparse. They also launched a cargo security solution in Panama with a partner, Narval Holdings, opening doors in Latin America.
So global expansion is definitely part of the offense. What about those Army contract issues that hit Q2 revenue? How are they addressing that?
McAleenan tackled it head-on, acknowledged the disruptions from the Army's efficiency and modernization efforts.
But didn't shy away from it.
No, quite the opposite. He said Big Bear will support the Army strategy, aim to capitalize on their investment in the new data platform, and fully intends to compete to win this work again, including a new contract called the Global Force Information Management contract.
Okay, so positioning themselves to benefit from the Army's changes long term.
He even said they welcome this type of disruption, framed it as a chance to streamline things and deliver software faster for missions. That's a confident take.
Very confident, almost turning a negative into a strategic positive.
And this all feeds into that bigger growth strategy, the going on offense theme, moving away from relying on just a few huge contracts.
Right, broadening the base.
Towards a deeper and broader pipeline. More customers, more prime contract bids, more international work.
Makes sense. How are they planning to fuel that growth, besides just having the cash?
Organically, they're launching intensive campaigns to capture that OB3 funding, targeting the private security market too, boosting marketing, hiring top-tier talent, senior advisors, operators,
Building the team.
and accelerating AI innovation. He mentioned frontier innovation, things like physical AI, integrating IoT, agentic systems, a step at the real cutting edge.
So pushing the tech envelope.
And then,
And inorganically, acquisitions.
definitely on the table. They're actively pursuing strategic transformational acquisition, looking to add scale, enter new markets, gain significant new AI capabilities quickly.
M&A could be a game changer with that cash pile.
And McAleenan really hammered home the long-term view, building for the long term, not managing quarter to quarter, bold talk after a rough quarter.
It really is. This whole section paints a picture of a company flush with cash, identifying massive market tailwinds like OB3, and pivoting aggressively to capture them. It feels like a genuine inflection point.
And it's a big but. They also updated their financial outlook because of all this.
What did they say?
They withdrew their previous adjusted EBITDA guidance for the full year 2025.
Pulled guidance. Okay.
Cited the uncertainty around those Army programs, plus the planned spending for all these new growth investments.
So acknowledging the near-term impact of the strategy and the ongoing Army situation, what about revenue?
They revised that projection down, now expecting full year 2025 revenue between $125 million and $140 million.
So tempering near-term expectations while aiming for that bigger long-term prize.
Right.
Sacrificing some predictability now for future growth potential.
Exactly. This sets up this fascinating tension.
It really does.
Mm.
The cash provides the means, the OB3 provides the potential opportunity, the strategy sounds bold, but can they execute against the headwinds and market skepticism? That's the billion-dollar question, almost literally given their cash.
So after this deep dive, where do we really land on BigBear.ai?
Well, we've definitely seen the core paradox, haven't we? You've got this quarter with really tough financials, a big mess, stock gets hammered.
Yeah, brutal reaction.
But then, contrasted sharply with this record amount of cash on hand and a CEO laying out a very aggressive, forward-looking offense strategy, targeting huge opportunities in AI, defense, security, fueled by things like OB3.
It's quite the turnaround narrative, potentially. And for you listening, why does this matter?
Well, it's a really compelling case study, isn't it? A company navigating that intense market pressure, making a clear, decisive strategic pivot.
Betting big on future trends in these high-stakes areas, AI, national security. You've now got the numbers, the context behind them, and the ambitious vision they're selling.
It really encapsulates that high-risk, high-reward dynamic we see in tech, and particularly in government-focused tech right now. The capital's there, the opportunities seem to be there.
But execution is everything.
Absolutely.
So here's something to think about. Given BigBear.ai's volatile past and the nature of their market, What's the real benchmark for success for this go on offense strategy?
Yeah, what does winning look like for them in, say, 12 or 24 months?
Will that massive cash injection actually translate into sustainable growth, profitability? Or will the army disruptions, the market doubts, the execution challenges continue to overshadow the potential? What really stands out to you about their path forward from here?